In this economic video, I would like to talk about bonds. Now, bonds caused me a lot of trouble when I was first studying economics, and they tend to cause all sorts of trouble for students of A-level, IB, pre-U economics, and more widely. A bond is a fixed income asset. Now, the trouble that I found with bonds was that they were referred to as fixed interest assets. And in one sense they are a fixed interest asset, but only if we define the interest in monetary terms. In other words, a bond will pay a fixed amount of money per time period, usually 6 months or a year. But that does not mean that that income payment is a fixed interest rate. As we will see, the interest rates on bonds vary, and they vary and can vary dramatically, as we've seen in this current financial crisis. A bond is a loan. If a government, for example, or also a large company, wishes to borrow money, it will try to sell bonds to prospective buyers. The buyer of any financial or indeed speculative asset looks for two returns: an increase in the price of that asset and a rate of return paid as interest while the person holds the asset. Now, with bonds, almost the entire reason why people decide to buy bonds, that is to lend money, is because they are looking for a safe income. The degree of that safety, of course, depends upon the creditworthiness of the borrower, and as we've seen recently, that creditworthiness can vary and can change. The British government in February 2013 lost its highest credit rating of AAA, and therefore ratings agencies felt that the UK government was slightly less creditworthy than before. That is, the chance of it repaying the debt was fractionally smaller than before. Let's have a look at how a typical UK bond works. A bond has printed on it a face value. This no more guarantees the price of the bond than spray painting your house with the price that you think it should be worth. It is the face value. That means that the government will repay that face value when the bond matures, but it does not mean that the price that people are willing to trade that bond is that face value today. Most government bonds mature at a particular date in the future. By maturity or redemption, we mean that the borrower of that money will, on that date, pay back the face value. Now, the easiest bonds to analyse, and the ones that I'm going to consider today, are those without a redemption date. These are called perpetuities, and the government commits to pay interest on these bonds for the lifetime of the bond, which could be infinity. They sound great, but they will have a very easily calculable market price. Now, people own bonds, of course, because they want income from the borrower. And the interest rate on the face value is given by what's called the coupon. In my case, 10%. Now, all that means is that the government, in this case, guarantees that the owner or holder of this bond will receive 10% of the face value every year, forever, as long as this bond is in existence. Now, 10% of £100 is £10, and that is what we mean by fixed income. The holder of this bond is guaranteed a fixed income of £10 by the UK government. Now, of course, guarantee is, in the British government's view, cast iron. The government has always paid, and if you believe the government will always pay. But you, as a lender, must make a judgment as to whether you think that money will be repaid or not. And as we've seen, of course, loans to the Greek government in the last 2 or 3 years have been agreed to be very unlikely to be repaid in full. So let us consider how we calculate the interest rate on a bond. Let's, for example, suppose that interest rates in banks are approximately 5%. That is, if you put your money into a bank, the bank will pay you interest of 5% a year. Clearly, if you only have to pay £100 for this bond, and the government guarantees that you will receive £10 per year, that is an interest rate of 10%, significantly higher than the bank interest rate that you could get with your £100. Faced with such an opportunity cost, it would be unwise to put your money into the bank when, if you put your £100 into a government bond, you would receive £10 back and only £5 from the bank. This means that at £100 the government bond is very attractive, and of course will not remain at £100 because buyers will flock to the government bond and purchase it. This will drive the price of the bond up, for example, to £200. At £200, remember, the face value will still be £100 and the government will still be guaranteeing £10 of fixed income. Now, a buyer of the bond must pay £200 to acquire it. Paying £200 and getting £10 income means that this income as a percentage of the price is now only 5%. And this relationship between an increase in the price of a bond and a decrease in its interest rate is eternal, is common, is a benchmark. We accept that this happens. An increase in the price of the bond will mean a decrease in the interest rate because they pivot around the fixed point of this fixed income payment. If we feel, for example, that now the government is less creditworthy, then the chance of being paid this £10 is now slightly lower than before. At this price, £10 looks like 5%, but if we feel that the £10 is less likely to be paid than before, we are likely to sell this government bond. If, for example, this government bond was sold off until its price dropped to £50, this would of course suggest that the interest rate on this bond were now 20%. And of course we have seen some interest rates of that sort of order in the recent financial crisis. Notice that a 20% return looks very attractive, but it looks attractive precisely because or is at least that high, because there is significant risk that the £10 will not be repaid. Government bonds are the primary way in which a government finances borrowing that is a deficit because the government spending in one year is higher than its tax revenue and it needs to make up that gap. And every year there is an outstanding amount of national debt, and bondholders expect to be repaid interest each year, so a significant drain on government resources around the world, with the exception of some countries such as Hong Kong or Norway. Those governments have to service debt, and service debt means paying interest, and there is a large opportunity cost of doing so.